Today we'll be discussing whether or not it is in fact go time for the S&P 500 after seeing the first dip bought over the last few days. And at the end of the video, we'll be talking about one new indicator we've been using that has been a huge help to our analysis. So make sure you stick around to the very end. So let's first talk about resistance, especially when resistance then turns into support. So this was one of the charts we're looking at 2 weeks ago, showing that there was resistance near the 61.8 retracement level of the entire decline from February all the way down to April. And as we know, that was just one form of resistance, because if we look at this chart, we know that that was a 200-day moving average right near 5,700, and then the whole zone starting with July high, extending all the way to where the market rallied back to. We know that in that spot, there was the initial area where the S&P paused after the big August rally, and then in the return to it, the breakout zone in September came back down, tested it once more at the end of September, early October, and then again right before the election spike occurred as well. And so because of all that, it seemed very reasonable to expect some sort of profit taking, or at least a slowdown as we got back up there, considering how quickly the snapback brought us there, right? Up 20% in a very short amount of time. As we know, that really didn't happen, did it? It did pause for a little bit, really just forming what ended up being the right shoulder of another inverse head and shoulders pattern. But from that point, gapping back above the 200-day moving average, and then consolidating around it really over the last few weeks after the most recent 6-day winning streak ended. So as we know, that has now created an even bigger cushion, this time on a short term, for the market potentially pull back to, which now has turned into a support zone as opposed to a resistance area. Very important to consider, because now it's bought the S&P 500 a little more time, and again, more leeway to now kind of ebb and flow as it potentially digests the next upswing. And so let's not forget as well that it was finally respecting support when this rally finally took hold back in the beginning of April. And as we know, there was a lot of data and a lot of chatter around that which caused that to occur, but I really think it's much more than a coincidence that it did happen right near a round number near 4,800, right near where the S&P 500 topped at the end of 2021 and at the 50% retracement level as well. So of course, hard to see all that when it was happening in real time and that volatile, but as we know, that was there. And the first step of eventually having a market come back and form an uptrend is to have either support respected or established. So on a short-term basis, it was established, right, 48.35. But on this much bigger view, it was identifiable, and enough people and enough programs realized it to, of course, have that initial bid now turn into a much more substantial rally. And so looking at this from one of the weekly charts we touch on a lot, this is the S&P 500 on a weekly basis in log scale, looking at the key weekly moving averages, the 13-week in green, 26-week in blue, and 40-week in red. And so when the snapback happened 2 weeks ago, and we had that huge 5% rally for the S&P 500, finally closed above all those lines. And last week, even though the S&P did pull back over 2.5% or so, it still was half of the gain. And we can see here too that it stayed pretty much above those lines. You have to really zoom in to see that it closed just below that 26-week moving average in blue. For the most part, it's done a better job so far than what we saw in 2022. And this was really the test we were looking at to see what would happen when the S&P 500 got back up there. Because the concern was when the S&P first went underneath that collection or that cluster of moving averages, that the initial rallies all failed, right? Even though the index did get back above both of those lines in that first big reflexive rally back in March 2022. So it wasn't really about rallying back to those lines. It was about doing something much more with it as we got through them once more. And so now we're potentially 3 weeks in, depending on how these last few days of May play out, where you could be right back above those moving averages. And as we can tell too, some of them are starting to curl higher once more. Another key factor we'll be looking at going forward is really how this 14-week RSI behaves, because as we know, we're still in this process of making lower highs going all the way back to the beginning of 2024. And as we talked about before, that didn't really matter on the way up. It was just a potential warning sign that we were looking for, not really a signal. And still waiting for that to change. At the same time, it's probably more important in this stage to see the RSI hold near that 50 level as we see maybe the next potential digestive phase take hold, because going back once more to 2022, that did not happen, right? The initial rally that faded pulled that RSI that was near or staying in between the 50 and 70 mark for a while back below it, and all those ensuing rallies failed to get the RSI back through that midpoint until the beginning stages of 2023. And so one of the keys, of course, for this comeback, especially in the latter stages of it over the last few weeks, has been low to a volatility. And so this is just the daily price action that we look at every day. And as is clear, if we look at nothing else, just the colors tell us all we need to know. A lot more blue and also a lot more light blue, meaning that, as we know, there hasn't been many 1% declines. Only one 1% decline since April 21st. But over that time frame, not counting today's action, there's only been 2 advances of more than 1% as well. And so this is what you want to see, of course. Always talk about one of the key traits to an uptrend is seeing a low frequency of 1% absolute moves, but more 1% gains than losses. And that's exactly what's been going on. And of course, that helped that 9-day winning streak happen. That helped that 6-day winning streak occur. But more importantly, in my opinion, is that after that 1.6% loss last Wednesday, there wasn't any downside follow through, even though we saw some negative action, of course, with the market down marginally on Thursday and down almost 0.7% on Friday. There was bids every time, especially in the early stages of Friday when the market opened more than 1% lower, and then the bid came in right away. That's very important to see. And because, going back to this chart, which we will continue to show because it's extremely helpful to illustrate the point where all this high volatility eventually gave way to low volatility, and that's when the uptrends in each one of these cases extended and the character changed from being volatile, of course, to being much more calm and persistent. And that's how all these bullish patterns can continue to form, fire, and have their targets hit. And that's what we're doing right now. Of course, there's still more 1% gains and losses, but you can see that there's all these spaces here of what just indicate no 1% moves at all. And we want to see more of that for the market to eventually get back to new highs and continue from there. And so looking more closely at the 1% moves, again, data through Friday, May 23rd, or at the moment, maybe 3, potentially 4 1% moves for the month, potentially 3 up and 1 down, which is, of course, much different than what we saw from March and April. We had 12 2 months in a row. And at the time, we were comparing that, of course, to 2022, because it was the last time we had 2 straight months of at least 10 absolute 1% moves. And also was the last time we saw at least 12 for the month going back to October. So all of those things, of course, coming after 2 straight 20% years made it seem like that 2025 was going to be volatile all year. And it could be, of course. We're only not even 5 months into the year. But as of right now, May is a big change. And the last time we saw a big drop off like that after at least 2 straight months was in April 2023, coming out of the bear market, coming out of those 2 corrections even after the October 2022 low. And that's when bullish patterns started to work. And that's when, the low to a volatility started to take over and the uptrend persisted. The same theme continues to play out over and over again. So in terms of the short term, the pullback from last week, so from May 19th high to the low, opening low on last Friday, May 23rd, the pullback was about 3.3%, which is not a lot, of course, compared to what we saw in March and April. But if you compare this to what we saw from this example, right, coming back from the July and August correction is that the pullbacks after that were we're pretty much in line with this. We've made an average of it, right? 4.5%, 1.6%, 3%, so forth and so on. And that just alleviated the very overbought levels on the very short term chart here, right? The 14 period RSI and 2 hour chart, which allowed the market to digest those gains, normalize those indicators, catch its breath basically, and then reestablish that bid. And that's what we're looking for to happen once more after this short-term RSI got to nearly oversold again near the lows last week. So once more, if we are going to be seeing the market replicate the best times over the last 2 years, this is the type of thing we'll see on the short term play out as well. Now, in terms of indicators, we can look at a few different ones, of course, but one we've been stressing a lot is the MACD, only because it tells us a lot, whether it's successful or not. And as we can tell here, with the market rallying so strongly and then, starting to fade just a little bit near 5,900 and 6,000, we're cautioning that we could be getting the next MACD sell signal. It got very close, and we'll continue to watch it over the next few days. But so far, if this was an official MACD sell signal, it hasn't played out yet. Again, we'll give it a few more days to get a good idea of if there's going to be any more upside follow through. But the point being is, we've seen this before. The last one worked great, coming right after the S&P failed to make a new high, and right before that in December. So 2 straight successful MACD sell signals. And again, look back what happened from 2023 on. These are all the MACD sell signals. The ones in red were the ones that proved successful, and the ones in blue were not. So it just told us that when you have mean reverting indicator like this fail to play out, it tells us that the trend is strong. And so right now, after 2 straight successful sell signals, if this one then fails, even after a huge move like this, it will tell us a lot, that the bid is extremely strong and there is a good amount of buy interest still, whether it's short covering or something else. And let's also recognize the fact that this has been a huge move to the point where, this is one of the biggest swings in the MACD indicator's history. Now, we wrote about this recently, talking about how we have to be careful talking about it being the biggest ever, only because the price level really matters, because it's using moving averages. Those moving averages, of course, very similar price levels to the S&P 500. So the moves in the indicator itself are exaggerated. Even that being the case, it's still the biggest since we saw in 2020, when that move to the downside was even more fierce, as we know, more than the biggest in history over a number of weeks, and as was the immediate response higher. So this is, no matter how we look at this, this is one of the biggest advances off of one of the sharpest declines since COVID. And we can go by what happened back then, where we talked about recently how not only the S&P 500, the XLK, and other areas regained those highs, we know that it didn't stop from there. So we'll see if that can continue to play out in the weeks and months that follow. Now, in terms of patterns, that means that both of our bullish breakouts that we've been tracking and their upside targets continue to be in play. The first one being a 61.25 target, which is getting closer, of course, and then a much higher one of 6,555, which would be considerably above the last high in February. And so the further that the S&P extends, the bigger the cushion that it has to pull back to, and it also can respect those breakout zones as well. And remember, that's how well things played out in 2024, when we had that initial push through 4,800, created that 6,100 target, as it continued to be in play because that breakout zone never got violated. But more importantly, along the way, smaller bullish patterns get formed and played out. Again, that will be the next step going forward. So once again, we only have live bullish patterns in play, which has been the case since the S&P 500 hit that last downside target on the morning of April 7th, the big downturn, which of course marked the low. So we'll continue to track this. We're still looking at any potential bearish setups out there, haven't played out yet. And even if they do, we see a formation and we see a downside break. If it can't get down to that downside target, that's going to tell us that, again, the bid still is there. So to review, we looked at how resistance has become support. We saw now the two-way volatility is in our favor, and all that has helped establish these bullish patterns and seen breakouts. So the question is, are we in go mode or not? And so one of the indicators we've been using, in fact, goes by that name, GoNoGo. So you may have heard of this indicator, GoNoGo. Co-founders are Alex Cole and Tyler Wood. Probably know those names. And it's been out there for a few years, and I've been using it a lot more recently. And so I would go to the website GoNoGo charts to get a much better explanation of exactly what's behind these indicators. But as we can tell here from this chart, it just gives us a good indication what the trend is and also potential inflection points. So in general terms, very bullish trend, dark blue, bullish, aqua or green here. And when it's amber or orange, and here it shows that it's neutral or it could be an inflection point. Very dark purple is very bearish, not surprisingly, and then lighter purple, bearish. And so one of the things that really stood out was that this indicator went from bullish to bearish within a few days of failing after the high, right? So it just tells us that in this area here, things were starting to just fade and not work out as much. And if you remember, that's when we started seeing bullish patterns fail as well in our work. So we got cautious. So at that point, showing that it was a change of character, this indicator showed the same thing. And so recently got to change to a bullish phase as the S&P went through 5,500, 5,600, and of course now remains in the bullish trend. Now, what's interesting about this pullback is that it looks very similar to what happened after the market came roaring back from the August low here. Got back up to testing the July highs, didn't make it, so that bullish trend temporarily dipped back to neutral, and then off we went from that point. And so if we look at it from that perspective, the market's trend is even stronger because it never dipped below into neutral, stayed positive the whole time, which shows us there is obviously buy interest underneath the surface. And this indicator can be applied on a weekly basis as well. And so again, very good at catching the meat of this bear market in 2022, got bullish in the beginning stages of 2023. Again, very similar to our work in looking at two-way volatility and looking for bullish pattern breakouts. That started to change as technicals, of course, started to move higher as well. And so we bring it to right here, still right now in the midst of going from bearish to bullish. And you can tell that if you go to this chart and zoom way out, over the last number of bear markets, it's a very good job of getting to the point where right before there was a major breakout that extended for years, this was right in it with showing us that we're in a bullish phase. And of course, it looks very similar to what we've seen in over the last 12 months when these higher lows, right, come into play the past few times at least. When the second up leg happened, that up leg was bigger than the first one. Now, that would be really something if that occurred right now, as we know, considering this was a 23% move or thereabouts. So considering that could even be bigger, we'll have to wait and see. And again, that will be predicated on bullish patterns working, low volatility sticking with us, so forth and so on. So now we know what to look out for this time. If you want to go back and see how this played out in early September, as we just talked about, check out this video.